Hello everyone. Once again welcome back to accounting theory class. Last class we were discussing about postulates of accounting theory and you have studied entity postulate of accounting, right? So in this class you are going to study about going concern postulate. According to this postulate, every business is carried on with a view to continue for an indefinite period of time in future. The financial statements of business units are prepared on the assumption that the business is going to continue along with the continuity of the enterprise. So according to this postulate, it is assumed that the business will continue for a long time, right? Each and every business concern has the intention to continue their business for longer or indefinite period of time, but not to stop or liquidate its operations within a short span of time, right? Under this postulate, the financial statements of business units are prepared on the assumption that the business is going to continue along with the continuity of the enterprise. So preparation of financial statements are based on the assumption that the business is going to continue, the firm is going to continue its business for indefinite period of time. Okay. Next, advantages. It helps for making distinction between revenue expenditure and capital expenditure. This postulate helps for classification of assets as fixed assets and current liabilities. Then it helps for valuation of fixed assets and historical cost price after depreciation for the purpose of balance sheet. Then this postulate is the fair basis for preparation of annual financial statements. So going concern postulate helps for making distinction between revenue expenditure and capital expenditure. Then what is capital expenditure and what is revenue expenditure? Sorry. Revenue expenditure means whose benefit is not exhausted within a year, and capital expenditure means whose benefit is exhaust not within 1 year. So under capital expenditure we can get the benefit more than 1 year. Say for example, investment made in fixed assets like purchase of land, purchase of furniture, right? So we can get the benefit for a longer period of time. But in case of revenue expenditure like payment of salary, taxes, right, so we cannot get the benefit more than 1 year. So its benefit will be exhausted within 1 year. Then this postulate helps for classification of assets as fixed assets and current liabilities. So in the same way, this postulate helps for classification of assets as fixed assets and assets as fixed assets and current assets, then current liabilities and non-current liabilities. A small mistake is there. Okay, anyhow, this postulate helps for classification of assets as fixed assets and current assets. In the same way, current liabilities and non-current liabilities. The intention of going concern concept is to continue the business for longer period of time, right? So based on this assumption, we can make distinction between capital and revenue expenditure. In the same way, fixed assets and current assets, and current liabilities and non-current liabilities. It helps for valuation of fixed assets and historical cost price after depreciation for the purpose of balance sheet. So it helps for valuation of fixed assets at historical cost price after depreciation for the purpose of balance sheet. So under this assumption, we can evaluate the value of fixed assets at historical cost price. Then this postulate is a fair basis for preparation of annual financial statements. Next, limitations. It is not suitable at the time of forced liquidation. So here, the intention of this postulate is to continue the business for longer period of time, right? But the conditions are in case of forced liquidation. Suppose any order by the court to liquidate the business. So in that situation, this postulate is not suitable. The company need to liquidate or close its business operations. Okay, then historical cost cannot be the basis of accounting because market price is more suitable base for accounting. Okay. Next one is monitor unit postulate. According to this postulate, the accounting entries made in the books are only of those transactions which can be measured and recorded in terms of money. Money has been regarded as the language of accounting. The events which cannot be measured in terms of money cannot be recorded in the books of accounts. So according to this postulate, so money is treated or it has been regarded as language of accounting, and under this assumption, the transactions which can be measured in terms of money can be recorded in the books of accounts. Those transactions which cannot be measured in terms of money should not be recorded in the books of accounts. Suppose you are the owner of a company and you have employed 1000 employees in the organization. So this transaction could not recorded in books of accounts. So instead of that, so you can record like how much salary that you have spent, okay, or how much amount you have spent for the payment of salary to the employees, right? The transactions like appointment of 1000 employees, so cannot recorded in the books of account. Okay, but you have paid salary of rupees 10,000, so you can record these kind of transactions in the books of account. Sorry. Advantages of monitor unit postulate. It helps for preparation of financial statements because money is a language of, or it has been regarded as the language of accounting. So it helps for preparation of financial statements. It helps to express the transactions in terms of money because the main intention of this postulate is to record those transactions which can be measured in terms of money, and the solvency of the business can be determined in an easy way. The limitations of monitor unit postulate. The purchasing power of money is not stable because the value of money may vary. Suppose you have purchased a machinery at rupees 10,000 at the beginning of the year, but at the time of preparation of balance sheet, the cost price of the same machinery may be 15,000. Okay, the historical cost is 10,000, but the current market price is 15,000. So purchasing power of money is not suitable. And this postulate does not record and communicate other relevant but non-monetary information. Suppose the efficiency of a manager or the relationship between the employees, then entrance of new customer, competitor, uh, then globalization, privatization, right? No doubt these all are very important for business, but we cannot record these kind of non-monetary transactions into the in the books of accounts. Okay, then financial statements do not reflect whether the profitability is based on effective or ineffective management, because so as I said, uh, the non-monetary transactions like efficiency of the manager are so we cannot record these kind of transactions in the books of accounts. So financial statements do not reflect whether the profitability is based on effective or ineffective management. Okay, these are about monetary unit postulate. Thank you.